Hi, this is Hutch with bankingtruths.com, and today we're going to talk about an age-old indicator that has accurately predicted recession over the last 95 years, and it is flashing red again. We're also going to talk about what you can do to protect yourself, your family, in recessionary times, or better yet, position yourself with pools of liquidity to take advantage of generational buying opportunities as recession hits. Asset prices come down, they revert to the mean. Perhaps this is just the prime opportunity for you to take advantage if you're well positioned. And that could be using traditional infinite banking, borrowing against whole life insurance, which is principal protected. You keep it compounding while borrowing against it, or using what we call the 4D banking method, where you apply the principles of infinite banking to a network, to a matrix of assets you already likely have in your life or could easily set up so that you not only keep multiple streams of assets compounding for you, but you can better and more safely manage the leverage and also more tax efficiently. Let's get back to the the recessionary indicator. Now, it's usually not just one thing that causes recession. The house of cards is usually wobbling on multiple fronts, but it often is just one thing that triggers a recession. And if we look at all the different things that could be this time, I mean, we're talking the threat of war in the Middle East. Obviously, there's a lot of tension there, and there's really no clear path to peace from either side. As a nation, we have been printing money to oblivion. We've racked up now $35 trillion of national debt, and with the relatively high interest rates, apparently it's just compounding on itself at billions of dollars a day. And even after watching the presidential debate, I didn't hear either candidate talk about a plan to bring down the national debt. Obviously, Kamala Harris has talked about lots of, let's just say, very interesting ways to spend taxpayer dollars, not all of which would be necessarily good for the economy. But President Trump, even in his last term, he did rack up more national debt, but at least he did so investing in infrastructure and things around this country. However, note that in the debate, he did talk many times about imposing tariffs, which will cause, although it may be good for our country long term and bring jobs back and strengthen the economy, it's not going to come without a lot of volatility for markets short term, which quite frankly, maybe why Goldman Sachs is endorsing Kamala Harris, because they just want the status quo. Who knows? All I'm trying to say is it's not like either presidential candidate is necessarily going to save us for the short-term volatility that is likely imminent. I did put out a video about just a few weeks ago. There was a lot of volatility in the market. It was very, very quick. It was basically a flash crash because of the yen carry trade in Japan. Now, just to sum it up quickly, it's really global leverage. So hedge fund managers, countries, wealthy individuals were basically borrowing. They were selling Japanese bonds because they could borrow them very cheap and use that to buy other assets. And then Japan talked about raising their interest rates internally after just decades of like negative interest rates and zero interest rates. And so all of a sudden we saw just the market just puked because so much of it, people would have to sell to satisfy these margin calls. And I just want to show you something called the VIX, or the fear indicator. Now, what you're looking at is the VIX. This is a monthly chart, meaning each month is a bar from 2008 to 2024. Now, up with the VIX is bad. That means fear is at an all-time high. And what I want you to see is the highest was 2008. The next highest was COVID. The next highest was just last month. You can see, in fact, if we look at 2008, we went from here to here in 2 bars. So this is one big green bar and a second big green bar that got us up to here. Same thing with COVID. We went here and here. It was 2 green bars. Notice this was 1 bar. It actually happened over a weekend. And notice how high the fear gauge got. And that just shows the fragility, like how fragile our economy is. And especially when it comes to dealing with interest rates. And that's a good segue to go back and talk about this historical indicator. So the historically accurate indicator of recession over the last 95 years is when an inverted yield curve uninverts. And I know that sounds confusing. I'm going to explain what that means. So typically an inverted yield curve is when the 2-year treasury yields are paying more than the 10-year treasury yields. And in theory, you should be getting paid more to lock up your money for longer. But what happens is when the Fed historically tries to tame inflation, they raise rates aggressively. And in fact, Jerome Powell said he was going to raise things until it breaks. And so when things start to uninvert, oftentimes it's too little too late and things have been broken. I first started talking about yield curve inversions a couple years ago when I did the historical case study of a 1980s whole life policy versus the ultra high savings rates. I mean, we had short-term rates in the teens for like 3-month treasury yields and high yield savings accounts. And whole life still found a way to outperform, but I digress. Anyway, you can see here, I even showed that there was an inversion back then between the 2-year and the 30-year, and there is again. And you can see where the red circles are, the blue, the 2-year yields, is above the 30-year yields. And it's usually around inflationary periods, very frothy periods of our economy where the Fed realizes that inflation is getting out of control. And so they aggressively raise interest rates. But what happens is we get this inverted yield curve where they raise so quickly that the short-term rates are above the longer term rates. And so the Fed was even, Jerome Powell even said he was going to raise until he broke something. Nothing's broken yet, but I think he achieved his goal. I think he's held, he hasn't been raising anymore, and now he's about to lower. And in a video a few years ago, I showed how a lot of times when the Fed starts aggressively lowering interest rates, it seems like that would be good for the economy, and it is in theory. It's just too little too late after these inverted yield curves. Now, I'm going to refer to a Twitter thread I read that was not by me. I want to give credit where credit is due. It's by an account called Game of Trades, where they actually go over a very in-depth history of when this happened. So you can see here, Game of Trades, this is the longest inversion since 1929. Something is about to break. Here's a thread. And you can see the chart, whereas like we were inverted to the point of like 1.5 points difference, which is very aggressive. If we look back over the last 95 years, we haven't been that inverted since 1929. And obviously we know what happened then. Now, this is to note is the 10-year and 3 months, so very short-term rates. The next slide in the thread, I'm going to put the thread in the description too so you can read it yourself. In August, the yield curve briefly uninverted, meaning it went from 0 to positive territory. So for a very brief moment in time in August, we uninverted, and then there's other examples actually. So yeah, you can see here the same signal occurred in May 2007. You can see here, it was just like very, very briefly, right? And then also in November 2000, so in the lost decade, both of these predated recession. Now, just to clarify, this chart is not the stock market. This is the level of inversion. So we're inverted down here. This is an inverted yield curve. And probably what's happening here and here in recession is they're trying to, they rose until they rose interest rates till they broke something, and then they're trying to fix it, but it's too little too late. In fact, every time the signal has appeared, it's been followed by an economic downturn. Even in October 1929, right before the Great Depression, the yield curve uninverted, aligning with the onset of a major market collapse. And so it just shows all these gray areas were recession, and it just showed that how steeply they just started trying to kind of fix things, but it was too late. All right, so before we go into the different historical examples that shows how long it took for recession to kick in afterwards, I want you to think about how you could be protecting your family, better preparing for these opportunities to, whether it just be keep your own house in order, or maybe it is preparing for these generational buying opportunities, again, through infinite banking by setting up a policy that you can obviously borrow against while it continues to compound in your favor. Life insurance is principal protected, or by having life insurance and having that cornerstone, that rock, that bunker that frees you up to be able to use this matrix of different possible options of keeping money compounding while borrowing against it with the 4D banking system. And in fact, I'm going to be putting out the Infinite Banking Starter Guide that talks about how you can do this. So let's get into this. This gets a little confusing, so I'm going to go quickly. what he says in slide 10 is the yield curve is cooled down, allowing the market to recover. So it kind of gave a little head fake here, or as he calls it, a whipsaw signal. And he's seen this multiple different times. And so the yield curve just uninverts slightly, and then it kind of goes back. And what's interesting, this red is the market. The market starts to go back up. It did it just recently. He shows that it did it in 2006, like it uninverted, all right? And there was a little head fake, but then it reinverted and the market went back up, which means hopefully you have time. Again, he saw a similar pattern here where there was a 20% drop and then a reinversion, but then a correction. Back here in 1989, there was like kind of a rumbling where like it reinverted, it inverted, it reinverted, it inverted. And with what we've seen with the volatility of interest rates, it wouldn't surprise me if we're in store for this. I do want to move on to like these whipsaw signals and what they mean for recession. So if we look at this chart right here, this is the yield curve. So when it's inverting, it's going down this way. And when interest rates are lowering to protect against recession are in these gray bars. And here's 90, here's the 2000s, here's 2008, here's COVID, right? He talks about the different catalysts. We talked about that at the beginning of this video. What's interesting is you look at the depth of how inverted we were. He actually compares this to 1929, and it's very, very interesting because you can look across history. Apparently there was some anomaly in 81, and it makes sense. This was super hyperinflation, which we haven't seen. So they just kept raising, and it was super inverted. But we have achieved the same level of inversion as 1929, not only from the amount of inversion, about 1.5 points, meaning the 2-year is above, this is a 3-month. The 3-month is above the 10-year treasury by 1.5 points, which is pretty inverted. It's not just that, but the number of days. And so what this chart is showing is the number of days the inversion has lasted. So 89, 70, 2020 lasted between 100 to 200 days, and there was a correction of somewhere between 10 and 30%. What's kind of scary is we are going on 750 plus days. And so the amount of time we've been inverted is now in line with 1929. So hopefully we don't have to experience a 60, 70, 80, 90% crash as was seen in 1929. But just notice that the parallels of not only the depth of inversion, but the length of time that we've been inverted. And we've seen when things correlate to the downside, they all go together, except for life insurance, which has built-in protection mechanisms that keep you from going inverted, at least in your cash value balance. And so I think it's important to start to think about how to position yourself now. Yes, there's certainly the potential that the stock market could keep going up. We're at all-time highs. The AI revolution is real. I do believe in the technology and how it will actually help revolutionize things, but I don't know if the potential extra rewards we can get from here, from all-time highs, are worth the risk of a large scale of what's possible on the downside. So it doesn't mean you need to wholesale change everything in your portfolio, but maybe it's worth a conversation with a qualified and licensed professional. I since dropped those licenses, but different agents that we have that help us, our clients with infinite banking, are also duly licensed, fully licensed to give investment advice. Perhaps it's worth a conversation to see how the whole thing ties together and how to better position yourself for what possibly may be coming. Anyway, I hope you found this helpful, and we'll hope to talk to you soon.